My name is Jim Walter, and I am the president of LegacyTree Foundation, and I'm very excited to be here to get to share some ideas with the folks at NFI Solution and the advisors that they work with. So we're excited to be invited to do this presentation for you. I think it's going to be pretty exciting because we're going to share some unique planning ideas, and hopefully this is going to be beneficial to some of your clientele and to your practice, of course. If you're not familiar with us or the programs we offer, I'm pretty sure you're going to be excited about some of the new opportunities that you're going to see us present here today. Let's just jump right in and get on to the disclaimers. And we always have to do that, of course, with pretty much every presentation. So a couple of things I want to say here. We are a 501c3 public charitable organization, so it's important for me to, we're going to talk quite a bit about tax deductions, the benefits of charitable planning. So in a setting like this, it can sound a lot like financial or tax planning, but it's really key that we understand, and it's important for us to understand that we are a charitable organization. We're a 501c3 public charity. So point 4 there. What we're going to talk about is charitable plan giving transactions as outlined in the IRS code. So these are not considered investments. They're not to be presented as investments because we're not an insurance company, broker, dealer, financial institution. Of course, we don't give tax, legal, those kind of advice. We're not securities organization, so we're not giving securities advice. We're available in most states. So if you got an invitation, you're probably in a state that we work with because we're in just about every state. So before we proceed, let me just share one thing we'll go over today, and that is a LegacyTree Foundation. That stands for LTF. That's the LegacyTree Foundation. LegacyPlans. That's what we're going to talk about. What is it? Let me just say as a note, I apologize if in some cases I might get a bit elementary on some of the subjects here, but I've been in meetings, where presenters assume that we all know the vernacular or the jargon of the specific products or the company that they mention. And they mention all these acronyms and letters, but they don't tell us what they are. And in some cases we don't know. So they go on talking about these letters. And if we don't know what they are, then it's kind of hard to follow along. So I know not everyone is familiar with some of these programs and the possibilities in the charitable arena. So I just want to make sure that we're thorough about what we're doing today. So a legacy plan is, the slide tells it all. It's a simple transfer of an asset to LegacyTree Foundation. Those are the 4 main assets: cash, annuities, securities, and real estate. We'll talk a little more about each of those and how they work. So they transfer an asset to LegacyTree Foundation. In exchange for that, they get immediate or deferred tax favored income for life for a set number of years. That sounds pretty easy. But because we're a 501c3 nonprofit, then there is an income tax deduction. There's capital gain reduction and estate reduction when that's applicable also. And so that's why I wanted to pop that description slide in there so we have that in our head now when we'll mention Legacy Plan a lot. But I want to touch a bit more on who we are and why you're here before we get to a couple of case examples. So in case you're asking yourself, why are we here? Or what you expect to gain by spending a few minutes with us today, here's just a few thoughts that I want to cover with you. First of all, most of the advisors that we work with are not familiar with these types of charitable planning tools. And this is just my opinion, but I personally believe that if you don't have at least some simple charitable planning tools available, you're probably missing a nice opportunity to help some, if not many, of your clients at some point. And so for others of you, you may not be securities licensed, or maybe you've chosen to let those securities licenses expire because of all the new compliance, financial obligations, expenses that are associated with that. I used to be securities licensed, so I know a little bit about that. And as a result, you don't now, or you no longer manage clients' assets. And so I've come to learn that there are many seasoned advisors in that category. And so a lot of times, and the reason that I bring this up is because we'll talk about some charitable planning ideas that are very effective for you and, of course, your clientele. And there's something that you can offer even if you no longer manage assets. A lot of people think that you have to be high net worth or you have to be managing assets in order to be, have this be one of the solutions in your arsenal. Point being, most likely you're all qualified to add these programs to your planning arsenal, as I just mentioned. For your practice, what this means is you've added a nice new revenue source. We like to say this is a way for you to increase your production without having to add new clients. And this should be one of the most important things I say in this meeting to you, because the reason being that you have a lead source and a new revenue source right in your own current book of business, right now in your own file cabinet. And so who are these people? Obviously, they are your existing clients. Emphasize that word. So most of the cases that we do here are with advisors, with their existing clients, using their existing assets to fund their legacy plan. Many times, most of the time, these are assets that you've sold to them or that you currently monitor. And so you actually have a potentially new revenue source, right there within your grasp, by simply assessing what we'll talk about today and then seeing which of your existing clients might benefit by some of these ideas. So most of the clients we end up working with are what we call average clients. And what that means is that they're not just high net worth people, as I mentioned, but people that have some assets and could benefit by reducing their taxes. So we can be a great reason to communicate with your existing clientele about tax issues that are on the horizon with some of their existing assets. And the truth is, we're right in the thick of it right now because we're in tax season. So it's a great time to discuss some of these issues with your clientele. And the point being that all this is about is that it means you can do more business by doing more production, or maybe doing different type of business with your current clients by helping them, one, reduce their taxes. It could be reducing their taxes now this year, and or when they pass those assets to the heirs, it could be more tax efficient. You can help them create income for themselves and or their heirs. And your clients get to help people in need through the charitable component of these programs. So I like talking with folks like you that are on here because obviously I think you have the greatest potential to implement these types of programs because, well, first of all, you're financial professionals. Secondly, you already have a book of clients, which means that you have hands-on access to seeing what their assets are. Many of your clients are more than likely, most of them probably have some type of assets that could be maybe repositioned to better serve their long-term goals. And so what I'm going to share today may be the most suitable and beneficial scenario for many of these clients and for their assets. I just believe you guys have a level of expertise and sophistication that matches up very nicely with the types of programs that I'm going to share with you today. So today we want to give you some highlights of these unique plans so that you have an idea of when to get us involved in helping your clientele with some of these unique benefits. And so what I want to do here is go through enough information, give you enough information so that you know when to call us. Now, obviously, the folks at NFI have been gracious enough to have us do this webinar, and so they're going to want to communicate with you about what we're talking about today to see which cases or clients or potential asset situations would be good to communicate with them about. But then you're going to, either you or through them, you're going to communicate with us to set up some of the case design and the structure of these programs. And I'll talk about that in a moment. But that's why we want to talk with you today, is just because we want to make sure that you understand that you don't have to be experts in what you're doing here, because that's what we do for you. You just have to know when there's a client situation where you might want to get us involved. And that's what makes this thing great for us. So why are we unique? I like to say that we're a unique organization. I just talked to some people recently asking about our charity, and they were in a charitable that provided fresh water to people, and why we're unique. And I said that we're unique in a couple of ways. First of all, the mission statement of LegacyTree Foundation is to provide spiritual, physical, and humanitarian aid to those in need. That's not necessarily unique, but we're a Christian, faith-based charitable organization. We've been here since 1999, so we're not new at this. But what makes us unique is that we don't raise our funds like a typical charity. We don't have a donor base. We don't have alumni like a college, or we don't have church members, or we don't have cancer patients. Or wounded people like the Wounded Warrior, those kind of things. What we do is we work with financial professionals, just like all of you, sharing ideas of how some of these simple concepts that are outlined in the IRS code may be beneficial for your clientele. Some of the, some of these concepts have been around, actually before the IRS code even existed, and anyone can benefit from them. So I like to continue to point this out. It's not just high net worth clients. We like to say that if a client itemizes their tax return, that may be a prospect for some of these planning ideas. Of course, we're federal and state regulated. We are a 501c3, so we're regulated by the IRS. And then in each state, we have to go, jump through the hoops of every state. So that's important. We have something else. Our reserve method is what's unique with us too, because rather than for us to self-insure and or invest reserves in more volatile or uncertain investments, we invest in an insurance policy. And I say that because 100% of the present value of the future income payments that we make to our clients, your clients, are insured. And we'll discuss that a little bit more in detail in a moment. One of the other things that makes us very unique and a benefit to you is that we compensate you. And so our model includes a referral fee that we've made available to you. And so not only do you get to offer these benefits, charitable programs, it's unique that we actually compensate you for doing that. And I'll touch on that later as well. And then I did mention earlier that clients get to get involved in the charitable component because we allow clients the ability to recommend that immediate grants be sent to the charities that they are interested in seeing benefit from this program. So what's nice about that is rather than for them to wait, like with most charitable plans, the charitable aspect of it happens after they pass away. So in our case, rather than waiting for a death, we send our grants to their recommended charities while they're still alive. So your client gets to enjoy the giving while they're still living. I didn't mean to make that rhyme, but I like that now. I think I'm going to use that. They get to enjoy their giving while they're still living. Because then of our unique model, and of course with your participation, this is where we're able to help clients solve issues with problematic assets. And this is where we talk about how to help the clients keep more of their money. So let's talk about problematic assets real quick here. We say problematic assets. Of course, we're not saying an asset is inherently problematic. I don't think the terminology or the definition of asset would be considered an asset if they were bad. But I think we'd probably all agree that assets are typically going to do what they're intended in their accumulation phase. So that's a positive situation. But as we approach the distribution age, or when clients are passing assets to their beneficiaries, that's when they can become problematic or have some issues associated with them. I listed the four main things there. You know what they all are. You can see them on the screen there. But it's pretty simple. I mean, cash and CDs, there's low interest, growth is taxable, surrender penalties, securities. What do we got? Market volatility has been a rascal the last year or so. There's taxes on them, even if they lose money. There's always capital gains on them. So that's an issue. Real estate capital gains is a huge issue. So that's a big thing with the taxes. The liquidity can be problematic. Liability and rental issues, if you get into that, selling costs, hassles, all that kind of thing. And so annuities, that's another one. Sometimes they're mediocre growth. There's surrender fees, typically, well, almost always, for a certain amount of time. They're always taxable to heirs. That's the big thing, and that's what we'll talk about a little bit later. There's volatility depending on the type of annuity. So you know all that. And these are great assets, and many people become very wealthy utilizing these types of assets to get to their great wealth. But for our discussion, we're thinking about if or when they may have some upcoming problems and how we can be a solution option for them. And that's what we're presenting today. So this is the slide where we kind of separate what we do from what you may be familiar with. Let me clear my throat. And so this kind of gives us a big picture because it's really a simple concept. And I know some of you are pretty familiar with charitable planning, so you're already going to understand this. But for me, I got in the financial services business back in 1984, and it was about 16 years before I'd even heard of charitable planning. So I was like everybody else. I knew how you make a donation, to my church, or to make a donation to Salvation Army, or to Teen Pregnancy Center, whatever it might be. And I knew that you get an income tax deduction for that. I think everybody's pretty familiar with that, so it's pretty common knowledge. And I put it on the screen there. So if a client transfers $100,000 to a charity, and if they're just going to give that money to the charity, it's going to be 100% or $100,000 tax deduction. End of story. Everybody knows how to do that. So here's why this is something for many of your clients. This is what we call a split interest charitable transaction. And what that means is that the client transfers the asset to the charity, same asset, but they don't just give the entire asset. They do transfer the entire asset, but only part of it is considered a gift, and there's a tax deduction for that portion. But the other part is returned as income over a lifetime or a specified number of years. And so that's what makes it the split interest. It's part tax deductible, it's part return of income. And so what these legacy plans can do is allow people with not as high of a net worth to benefit from the charitable planning because they get the tax help with the partial deduction now, but the income stream over time usually pays the entire asset value back to your client and or their heirs. Let's just look at a couple of details regarding this and how that works. So again, they transfer $100,000. First part of it is they're going to get a charitable income tax deduction. What is that going to do? It's going to reduce their current income taxes in the current year. So as I mentioned earlier, if a person itemizes their taxes, they may benefit from this tax deduction. If it's a capital asset, they're going to have a capital gains reduction. If there's a estate tax, it's not an issue right now typically, but if that's the case, the estate tax, the value of the estate, value of the taxable estate is going to be reduced by any transaction. And again, I'm going to say this, and again, hopefully not too many more times, but it's not just high net worth clients. Everybody likes to save money on their taxes. The other things, if it moves somebody to a lower tax bracket, that's all the better. It's really important for us to remember that when you have a tax deduction, it starts reducing your taxes at the highest tax brackets first. So if it takes somebody down to, say 300,000 of income down to 200,000 of income, for example, and they move to a new tax bracket, they've knocked everything off. Say if they're in the 35% tax bracket, it knocks them down to the next lower tax bracket. So they wouldn't pay anything in that 35% bracket. So that's why that can be a huge benefit. A lot of people also will apply an income tax deduction to minimize taxes if they were to do a Roth conversion, or if they want to reduce taxes on their RMDs, the required minimum distributions. And even some have used the tax deduction to access some of these qualified funds tax-free. And I will show you a slide on that in a moment. The other part of it, of the equation for our split interest transaction, is that's where they get income. We've all heard it said that it's better to give than to receive. And if we've been in that situation, we know the joy it is of giving. But we like to say it this way also. It's also nice to give and receive. And that's where it happens in this case with the split interest type of planning. And so they get income. Can be immediate, can be deferred, lifetime period certain, could be for themselves, could be for their heirs. We call it a structured inheritance. Some people, mom and dads, like to have money going to their kids with an income instead of a lump sum. And so we call that a structured inheritance. A lot of people will use the income from our programs to fund asset replacement life insurance. And that way they're able to potentially get the most value to the kids in the most tax efficient manner, and in most cases in the easiest manner too, because the kids just basically receive the money at that point. The final point being here that then the client gets to recommend charities that they would like to see benefit from their transaction. And so that's where the real joy of the giving part comes in, is to see charities that your clients are interested in seeing benefit. They actually benefit right now while your clients are still alive. And so the summary of all this is almost every case we do, they get the tax deduction, but more income is usually paid back over time than the original value of that asset. Again, in addition to the reduction of taxes that was created, in addition to the charitable grants. So it really makes a pretty awesome scenario for us. Here's how it works. We're going to assume here that the client transfers the asset, but before they do that, we're going to make sure it's suitable, it's beneficial. We're going to make sure we've disclosed how it works and they understand exactly what they're doing. Could be cash then, could be securities, could be annuities, could be real estate. But ultimately, they're going to transfer that asset to us, and we're going to issue them a legacy plan contract in return. And so that contract is going to talk about the income tax deduction, the capital gain reduction, if that's their estate reduction, and then the terms of the income, whether it's immediate, deferred, term certain, or lifetime. Pretty much that simple. And so I've outlined this in blue because really that's all that happens on the front side of that. Everything that happens after that is the back office stuff that we do after the case. And so first of all, we're sending them money. At some point, they're going to start getting an income stream. It might be immediate, it might be deferred, it might be lifetime or term certain, as I just mentioned. But because we're promising them that income and have it in a contract, then we have to set aside funds to reserve the value of that future income stream. And this is where I talked about earlier about our reserve method. So instead of us investing reserves into something potentially volatile, we simply invest in an annuity contract from a highly rated and familiar insurance carrier. So we're going to put 100% of that present value into a contract that's going to match the obligation we have to the client. And then when the time comes for the income to begin, we usually have the payments go directly from the insurance company right to the client on our behalf. And so this is awesome because we found out it tends to really increase the comfort level for a lot of people. A lot of people like seeing the money come from an insurance company that they're familiar with, they probably heard of, and so are the advisors. We found out, if it's coming from one of the companies that we use that you undoubtedly will have heard of. So then, of course, the reason any of these benefits are available is because this is a charitable plan. We allow, as mentioned, the client to recommend the charity to benefit. And so we send out the immediate grant right when we close the case. That's just all part of the closing process. And then again, they get to see that gift of giving while they're still alive. And so that's an awesome scenario. That's pretty much how it plays out. Not to be confusing, let's say what we have available. Two things we offer. We actually have a third one. I'm not going to touch on it here, but I'll just mention it at the end of the slide. But we have two programs. Basically, for the most part, the difference in the two is how the income is received by the client, whether it's term certain income or whether it's lifetime income. On the left, that's the one that pays the term certain income. Probably 99%, and literally 99% of the cases that we do is set up with an income that can be paid to the client for a predetermined number of years. So if we set it up to pay 20 years, we're paying your client or their beneficiaries for 20 years. That's how that's set up. On the right side, that's a charitable gift annuity. These guys have been around since 1843. So they've been around a while, and this one pays income for a lifetime. Some people like to use that because they can maybe fund life insurance using this because it pays the income, we pay the income to them, and they use it to pay the premiums on life insurance for as long as they're alive. When they pass away, this income starts, but then the life insurance death benefit pays out. So these work a lot like a regular annuity. It's just that they're through a charitable foundation. Therefore, you can fund them with assets other than cash. The four assets that I mentioned, of course. And because we're a charity, then there's tax benefits included, all of those I've mentioned. It's also important to note that there's no fees involved in this. And it's also important for you to know, as a follow-up to that, these are not a trust. You're all familiar, or some of you are familiar with a CRT. That's a charitable remainder trust. And that is actually setting up a trust document. These are not that. These are simpler than that. It's transferring the asset, filling out the application, they get a contract in return. That's it. No setting up of the trust or the expenses or the ongoing tax filings or managing assets in the trust. I'm not saying those are bad. I'm just saying those are more complicated. And for these types of assets, it might be better in many cases, and based on the size, to do this type of a program instead. So let's get into some more details here. Earlier, we talked about how certain assets have the potential to become problematic or can develop tax issues. And so, again, as I mentioned earlier, our purpose here today is to spark or ignite some thought as to which of your clients could benefit from these types of plans. Again, the point is you already have clients, so it's not a matter of having to go out and prospect. Everybody likes to hear that because you already have the potential clients there. It's a matter of thinking what assets they hold and if you can alleviate some current or upcoming tax and or income issues. So think about your own book of clients, and if they have any of these assets with any of these potential issues. And so let's talk about the four asset types here now. First one is cash. And regarding cash, I'm going to go through these a little bit fast because I don't want to be redundant, and I don't want to take a lot of time here. You can take a picture of the slide. Actually, I'll give you the whole slide, and then if you want to take a picture, we will have this recording available as mentioned. But here's the first thing with clients with cash. And the thought is, which of your clients think they're paying too much in taxes or wants to reduce their tax? So who doesn't think they're paying too much in taxes? I don't know. Can you think of anybody? I think everybody thinks they're paying too much in taxes. So if you have discussions with your clients about tax reduction, more than likely they'll want to know about these ideas. Most cash assets like CDs, money market savings accounts are low performing, but you still have to pay tax on them every year typically. And so this can be a great scenario to move those over and create some tax deductions. Maybe someone who sold a significant asset recently. Matter of fact, last year we had a client in 2022 who sold his business, significant tax issue facing him. He didn't do the research of what he maybe should have done ahead of time about how to avoid some of it at the outset. But so he did the transaction, and then he was looking for answers when he heard what his tax bill was. So in his case, he transferred $1 million. That's bigger than our normal cases, but he transferred $1 million to create a tax deduction, set up the legacy plan with deferred income. So the tax deduction now helped him reduced taxes on the situation, but now he's going to get income later from this because he didn't need all that income at this point anyway. So transferring cash to create that deduction can be a really sound tax planning decision. Again, the RMDs are an issue. A lot of people have to take those. Tax deductions help offset that. A lot of people have done cases where mom and dad didn't want the kids to inherit a lump sum, so they'll set this up to create. Well, a lot of parents don't want to provide a legacy. They want to provide a legacy to their kids and not a lottery ticket. So they don't want kids just getting an asset, inheriting it, and then cashing it in. Then not only that, but they got to pay a bunch of taxes on it in many cases. So this is a great way to provide a structured inheritance to the heirs. Another one, and I'll show you a slide that kind of fits into this category, is highly paid professionals who've exhausted or maxed out all their other retirement funding methods. If your client has a high income, they're not able to fund a Roth IRA. You can't put money in a Roth IRA if your income is above a certain level. IRAs, you can only put so much in. 401ks, you're limited. Some of the other methods are limited as also. So this can be a great supplemental vehicle that can provide an income tax reduction for your clients. And then at some point, they're going to have the income for retirement planning or whatever, all with helping a charity. So there's a lot of wins in that situation. On the other side of the equation, I've combined the real estate and the securities there, mainly because the benefits of the legacy plans funded with the securities and the real estate overlap a little bit. And I didn't want to be too redundant, but there's a significant extra benefit that a client gets when utilizing a capital asset to fund one of our legacy plans. That is that they get the charitable income tax deduction, but they also get a reduction in the capital gains. And so like the chart I showed before, if they're going to get a 40% tax deduction, if they do 100,000, they get a 40% tax deduction. If there's a capital gain involved, then 40% of the capital gains is going to be eliminated or reduced also. So they get two benefits in one. So these types of assets are awesome for this type of planning. But the big problem with these is the capital gains that they have to deal with. So with both of these type of assets, we see numerous clients who would like to liquidate or exit from these assets, but they don't because of the capital gain issues. So they continue to hold these assets, and then get taxed on them at some point. But I'm gonna take a stab in the dark here, and I think you'd agree with me, but I'm gonna guess that capital gain taxes are going to go up in the very near future. It's just a guess, but I think we'd all agree that it causes some urgency in that situation. Of course, the step up, a lot of you are thinking, yeah, but there's a step up, and that is an awesome benefit. And hopefully that stays intact, because that is one of the premier benefits with passing capital assets to kids. But with many folks being happy again where they are and the growth of some of these, the securities or the riskier type of assets or the growth in their real estate, many would like to make sure that they're protecting themselves against market losses or a real estate crash. So they want to keep the value of that intact. Nothing worse than if the values all go down, you have a 40% drop in your securities, and then they get it and they get the step up. Well, they probably could have done something different that would have saved them money and then have it locked in and not have to worry about what the government does or what taxes do. So especially for senior clientele, this could be a way out to reduce the capital gains, reduce income taxes, and lock in an income from the legacy plan for themselves or for their heirs, either now or in the future. Some folks like the idea of the current appreciation that they've had and provide a higher legacy plan income. Because what that could do is to help them use that extra income for an asset replacement life insurance. I've alluded to that. And so the policy that could get the value of these assets to the kids more tax efficiently or even tax free. So that's a nice benefit. One other point here that I like to make is the last point there on the securities side is that this is especially valuable when you're thinking about your senior clients who own real estate. So think about your file cabinet. Who's got that? Because the older they get, the more they want to get out of the real estate. Usually, I've got some real estate. I know, and when I do these programs live, and I say who owns investment real estate, half the audience, you people, have real estate as well, so you know what that's like. The problem with the real estate assets is as they get older, they want to get out, but they don't because of the capital gains. And the other problem is if the kids inherit it, the kids don't necessarily want the real estate either. They might not even live where mom and dad live anymore. And so let me ask you the question, what do the kids want? Well, the kids want the value of the asset. We know that. So this is a perfect scenario where folks can fund a legacy plan with real estate, great income to purchase life insurance, so the kids get the value of the asset and not the land or the rental property. The rental house comes with the 3 T's, we like to say, the tenants, taxes, and toilets. But they also get the hassles, the costs of all that if the kids have to deal with that later. So this is an excellent scenario. And the other great thing about it is you might get compensated twice, because we're going to compensate you for the legacy plan, but you're also going to get compensated for whatever life insurance program you select. So just because I mentioned securities here, I want to make sure that you remember we're not a broker-dealer, we're not a financial institution, we don't give securities advice. So it's up to you to make sure you're properly licensed if you give securities advice. So that's important. And again, to point out, these are charitable plan giving programs, are not investments. They shouldn't be represented as investments. All right, annuities, I've got a bit more to say about that on a brief case study regarding the use of an annuity to fund a legacy. But just 2 points here. How many senior annuity clients do you have, and what are they going to do with their annuities? Most are probably quite happy with their annuity purchase decision. You might have even sold it to them. They're working great for tax deferral, for retirement, for income planning. They didn't go backwards, more than likely. But now what are they going to do with their annuities? So the second point there is we're also looking for those clients who plan on passing their annuities to their heirs. And so let's just jump into an annuity case study. First thing we're looking for, probably your own clients. And it could be clients who have done well on their annuities. Could be clients who are not happy with their annuities, but the best client, though, for purposes for our conversation, is the client who plans to pass their annuity to their heirs. The key point of this is that annuities are not necessarily the best asset to be used to transfer wealth. They're great for protecting assets and tax deferral, as I mentioned. But as we discussed, we know we know annuities have been good so far. But the challenge is that, and I'm sure most of you already know this, but currently less than 5% of people annuitize their annuities. So the kids inherit the annuity, they also inherit the taxable gain or the growth. Plus, many of the beneficiaries cash it in, right when they get it. And so that's going to cost them more in taxes, maybe even move them to a higher tax bracket. And the point is, you really don't have many decent options, especially as your clients get older. Most annuity companies actually won't even offer annuity. Well, they all won't offer annuities at a certain age. And most likely they'll be considered unsuitable. There'll be new surrender fees if you want to put them in a different annuity. So that's most of the time not realistic or suitable either. And you get paid less the older the client gets. So that affects you and your pocketbook as well. But according to the IRS, when someone, mom or dad, transfers an annuity to a charity, a 1099 gets issued at that time. But the good news is the legacy plan creates that tax deduction that can offset those gains now, so that ideally the kids will receive the asset value in a more tax advantaged way. So that's why that can be good. And so even though they transfer their annuity to us, they didn't give it all to us. Remember, this was a split interest plan. So it was partially tax deductible and part charitable. So they're creating the deduction and they're going to get the income. Could be for themselves, again, if they need it. But in most cases, what they do is they have it go to their kids when they pass away. And that's where we call the structured inheritance. And they do all that without having to create the trust. So here's the story. This is Rob and Irma purchased an annuity for $100,000. We'll just keep the numbers round here for the example. They wanted to put money away, tax deferred, potential growth, all the reasons you buy an annuity. It's now worth $150,000. It's got a surrender value, so it's $140,000 of value, and it's got a $50,000 gain. They put in $100, and now it's got $150 of value. And so they're not going to use it like most people. Some people, again, they might take a withdrawal or two out of it, but in most cases, people don't annuitize. I think Limmer says it's like 99%. I don't know that to be specific, but exactly right. But it's a high number that don't take their annuities. So here's what they did. They transfer their $150,000 annuity to LegacyTree Foundation in exchange for the legacy plan. So then, as we showed in the chart earlier, we're going to issue the legacy plan at $150,000, even though they transferred it in its surrender period. And that's because that's the value the IRS recognizes. So even though we're getting the actual surrender value, the tax deduction can be based on that accumulated value. It gives them a higher tax deduction. So a number of things are going to go in the contract: the term of the payment, the deferral period of their income, there's a surrender value, the income versus charitable amount. All those things are going to be shown in the contract. So the contract determines what they're getting, and here it is. First of all, they're going to get a 63 plus income tax deduction. If that's all in the 22% bracket, it saves them almost $14,000. So what we're able to do is use the tax deduction to offset that 50,000 of growth. Remember, they had 50,000 growth in the annuity. Allows them to settle up with Uncle Sam now, so the kids won't inherit an annuity with a lump sum tax attached to it. And then if the deduction is large enough, which it is in this case, it can also reduce their regular current tax liability. So they only use 50,000 of that deduction to offset the gains in the annuity. So there's another 13,600 that they can use to reduce their regular taxes too. So it's going to actually lower their regular income also. Then they're getting income, 5 years deferred, 20-year pay. They're going to get over $9,000 a year for 20 years. Again, for most of the cases we do, mom and dad don't plan on taking the income, but they still have the ability to access it, or they can name their children as beneficiaries. This is nice because many parents would rather set up the structured inheritance, as I mentioned, for this part of their estate, rather than have them receive everything in a lump. So we're going to insure that as usual. 100% of it's going to be insured through the highly rated and familiar insurance carrier that we use. So the income, the tax benefits, 194 plus versus the 140,000 of surrender value that they had. So this is an important thing for you to think about for 3 reasons. One, you have clients that will never access the annuity that they have. 2, they would like to avoid passing the lump sum taxable event on to their children. And 3, they could benefit from tax reduction this year. It's a great case. We do a lot of these cases. This is kind of the low-hanging fruit in your arsenal. I shouldn't say your arsenal, your pill box of clients, your file cabinet of clients. Here's another case study. This is a cash case study. This is one we've done 2 years in a row with this individual. This is a true story here. Greg, 45, owned a construction company, still owns it. From Houston, back in the day, there was some horrendous weather and flooding, and his revenue went up amazingly because he had to do so much. So he needed to reduce his reportable income that year. He also wanted to set more funds aside for retirement. Here's what he did. So we'll just jump right into it here. He transferred $250,000, 10-year deferred, 20-year payout. What this did for him is create a $130,000 tax deduction. So that could save him in his tax bracket up to 31 something. So he accomplished all the things he wanted to do. Reduce his reportable income, moved him to a lower tax bracket, has money available for himself or his heirs for retirement income. And so that's what the goal was. And so there's the income. He's going to get 16.9, 338 over the time. The income is tax preferred. It could go to his beneficiaries if he doesn't need it. So he sets up the structured inheritance, just like we talked about. So that is an awesome case. Also, again, we're going to insure that. 100% of the present value of that future income is insured with a fixed annuity. And so that makes for an awesome scenario. He accomplished exactly what he wanted to do. He did it again. He did it a second year, transferred another $250,000, and did it again. He's actually got a partner. So the two of them actually, between the 2 years, they did 4 of these cases. Pretty awesome. Here's what it looks like, though. This is what's kind of cool to me, and what the real value is here, because this is a marginal tax bracket. And this is just a simple way of assessing what the taxes might be on the marginal tax bracket. So keep in mind, there's no other things considered here, no other factors. It's just an example. So we don't give tax advice. So the top half, his income is $250,000. If he didn't have any other deductions and he went with a standard deduction, you take the $250,000 of his income, and then right here you subtract that $25,100. That's his standard deduction. So he pays tax on $224,900, $42,000 to be his taxable. That'd be his actual tax bill. On the bottom side now, same $250,000, but he created a $130,000 tax deduction. So $250,000 minus $130,000 is $119,527. And so he did a couple of things. One, he's not paying any tax now in this 24% bracket. You can see up here he's paying taxes on $52,000 or $12,000 in taxes. Here he cut that out altogether, and so he eliminated that. But his total tax bill, he saves over $24,000 on his tax bill. So you can see how the tax deduction is beneficial in this case. And then it can be valuable to other folks taking the RMDs. Folks want to do a Roth conversion because he accomplished everything he wanted to. He created the partial tax deduction, so he got that benefit, and he got the return of income. He got all his money back plus a lot more. Beautiful situation. One last thing, then we'll get down to the wind up here. This one I wanted to show you about accessing qualified funds. This is a standalone slide you could use. I'll put them all out here for you. And then I'll tell you what we're doing. So what we're talking about here is how do we access qualified money and make it tax-free? And I'll say it first, and then I'll show you the slide, or I'll go through the slide. We create an income tax deduction by funding a legacy plan with a non-qualified asset. We pull money out of a qualified account or do a Roth conversion, something that's a taxable event. Then we use the legacy plan tax deduction to offset the taxable event that was created, converting the legacy, converting the qualified funds. So the info box at the top, they got 100,000 of income. They've got 60,000 in a qualified account. They've got a bunch of non-qualified assets. I just left that open. First thing they did is they did a legacy plan for 150,000 of their non-qualified assets, of their cash, let's say. And so that created a $60,000 tax deduction. All right, now they've got 60,000 extra tax deduction. They execute a Roth conversion or they take 60,000 out of their IRA. That's taxable. So it adds 60,000 to their income. The details, the purple one, their income was 100,000. It went up by 60,000 because of the qualified event, the Roth conversion or the 60,000. But they did a legacy plan with 60,000. That created a $60,000 tax deduction. Their income is right back where it was. The solution, the result is they still have $100,000 of income they're going to pay taxes on. That's the same as it was. Now they've got 60,000 available because of the Roth conversion or the distribution they took, and they've got a $150,000 legacy plan. So this can be huge to think about in the next year or so, since the current tax rates expire in 2025. So it seems like we'd have to assume the taxes are going to go up significantly after that. And so we really have a sale on what taxes are. So doing a Roth conversion, might be on sale for the next 2 years only. And so this is a huge thing to consider. It's how to deal with that. All right, let me rush to the end here. We're taking a little over time here, but let me complete this by saying a few things. I mentioned that we're unique because we compensate you. Our model provides you with a 7% referral fee. Some think it's weird for a charity to compensate anyone, but we've found that it's more efficient for us to pay the advisor when a case closes. A lot of charities spend a lot of money raising money. And so in our case, you've done the work, help the client save on taxes, increase their income maybe, help get money to charitable, to support charitable work that probably never would have gotten to a charity had you not helped your client. So you should be compensated. Here's what's really cool about it though, is it's nice because we issue our contracts at any age, and the comp is the same for all ages. So you don't have to talk about, you don't make anything. As you go, again, we're all want to do suitable and beneficial programs for our clientele, but it's nice if you can be compensated. The second benefit to you and to your client is our reserve method. Every case since day one is 100% insured with a highly rated insurance carrier. Charities aren't financial institutions, so when you talk to your clients about future income, you don't want to be a little iffy about whether the charity is going to be around, that a nonprofit can invest assets properly. So everybody needs peace of mind. You need it. We need it. Most importantly, your client needs it. And so we call it reinsurance, but we insure every case we've ever done. And the third thing is what makes it really sweet is your client gets to recommend charities that they get to see benefit while they're still alive. So this is a way that you're able to increase your production without having to add new clients. Our average case size is about 165,000. I know you probably all thought, ooh, I thought it'd be a lot bigger than that. Our lowest cases we'll do is down to 25,000, and then anywhere up to there. We've had a couple of them in the millions, 2 million or so, a few of those, but it averages out to about 165. So you can see if you did one legacy plan, 3 legacy plans, how that can increase your production by simply going back to your clientele and talking about situations that they might have coming up. Here's what we do. We take care of everything. I mentioned that we just want to have you get us involved. You don't have to know everything about it. You just have to know, you know what, maybe this is a case I should talk to LegacyTree about. We're going to talk you through the case design, make sure it's suitable, beneficial. We're going to make sure you're asking the right questions. We're going to make sure we have the right information. So we'll consult, we'll do the illustrations, we'll train you on what we need to talk about. We'll get on the phone with your client if you'd like. We'll email the closing packages. We have marketing materials, whiteboards, webinar recordings, similar to this one actually. So a couple things here in closing. Who are the primary beneficiaries? Well, the government is mainly. We call it involuntary philanthropy. Nobody intended to make the government to be that uninvited beneficiary. But there's what the flow chart looks like. IRS first, family, then charity. What we want to do is rearrange that order, perhaps family first, then charity, and then the U.S. government. And so we just feel, and I'm sure you do too, keeping the IRS from being a major beneficiary of part of your client's nest egg. That's what we're trying to accomplish here. If we can resolve that issue of passing taxes to the children, provide additional tax savings, that's going to be a popular discussion with your clients, and could certainly be a new reason to communicate with them. So a couple of quick points in closing. It all goes back to who is in your file cabinet. And the question is not if you have clients, but which of your clients simply want to reduce their tax bill. Many advisors say the more important issue right now for seniors is not the rate of return on some of their investments, but the amount of potential income taxes that they might have to deal with. And with the current taxes brackets changing after 2025, that's a good reason to, some have done the RMDs, some want to consider the Roth. And so in those cases, these are good years, next couple of years, to be able to try to accomplish that. And so that's important. The capital gains on the securities, especially real estate, are gobbling up so much of the growth people have experienced. Again, so you think of those clients that have, investment real estate for many years. They have capital gains. They also have recapture of the depreciation. This is where people really get burned. Actually, I should probably do we will do a whole real estate one, and that'll be part of that subject webinar. But the client creates tax deduction, capital gain reduction, and depreciation of recapture deduction. So, of course, all of you have a file cabinet full of these annuity clients. A lot of them are annuities. You've sold them. And so they're going to pass those annuities on to their kids, and the kids are going to inherit the annuity and the internal gains. And so a lot of people have done suitable cases with it. The truth is, it might be more suitable to do our legacy plan than to simply allow your client to pass the taxable annuity on to their heirs. So that's something to think about. As mentioned, finally for you, this is a way to increase your production without having to add new clients. So most of our cases are done with current clients using existing assets. Many times there are assets left on the table. So there aren't that many places where you can go and have these options where you can get that much tax advantage and income, all while helping those in need. So that's what we want to accomplish in our conversation today.